Continued war in Ukraine, senseless violence in a subway in Brooklyn, the tax man cometh, inflation really is as bad as we feared, and, oh yes, Elon Musk has decided he wants to buy all of Twitter. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on how bad inflation is going to get.
We're probably peaking for the next several months. Whether we're peaking indefinitely, I'm not certain that that's going to happen.
And Grover Norquist on whether there's a right way to get the taxes we need to fund the government that we want.
There's a certain point at which you can't get any more blood out of the turnip. We're probably above that point now.
It was a shortened trading week in the United States because of the Good Friday holiday, which postponed the day of tax reckoning until April 18. But holidays and taxes did not slow down preparations for a showdown in eastern Ukraine that retired Brigadier General Mark Kimmett says could be decisive.
I see this third phase, concentrating their forces in the Donbass, potentially be a game changer, but I also think there's some opportunities for the Ukrainians in this phase as well.
And sadly, there was no stopping a man from detonating smoke bombs and opening fire on a crowded subway train in Brooklyn, shooting 10 people. A man who, by Wednesday, New York's police commissioner and mayor were confident they had in custody.
We were able to shrink his world quickly. There was nowhere left for him to run.
My fellow New Yorkers, we got him.
The much-anticipated inflation numbers came in every bit as hot as anticipated.
In March, the CPI went up 1.2%. That's what was forecast. It was up 0.8% the month before. And on a year-over-year basis, we're up 8.5%.
Though some, like Jim Paulson of Luthold, expressed hope that this might just be the peak.
I still think, though, this is likely to roll over in the second half of this year, and we might be seeing this morning the peak in CPI inflation rate.
5 of the big banks reported their second quarter earnings this week, and with all but Wells Fargo exceeding expectations. Trading coming in particularly strong at Goldman Sachs and Morgan Stanley. But overall, the markets were in a selling mood for much of the week, with stocks down, the S&P by 2.4% and the NASDAQ by almost 4%, driven once again by the rise in bond yields. And the 10-year Treasury added almost 13 basis points on Thursday to end the trading week just over 2.8%. To take us through what we saw in this shortened trading week, we welcome now Gillian Tett, Financial Times Chair of the Editorial Board and Editor-at-Large U.S., and Peter Kraus, Aperture Investors Chairman and CEO. So, Peter, let me start with you. What were the markets trying to teach us this week, and did it have to go beyond bonds, or was it really all about bonds in the end?
I think the market is right now is all about what is the growth rate going forward and where is inflation going to peak. And that is what's driving the yield curve. And it's also driving what will ultimately be Fed's behavior in terms of interest rate hikes and in terms of the cessation of bond purchases and the reduction of the balance sheet. Those two things together, increasing interest rates and stopping purchasing bonds, that's what's causing the interest rate curve to actually steepen. And you saw consumer conditions come out today, University of Michigan current conditions, Michigan expectations, and expectations for inflation were actually more optimistic than what was expected. So I think we probably have, and I'm a little bit of a contrarian here, we probably have not a recession, we probably have a slowdown in growth, but a persistent expansion. But that has got to be accompanied by significant increases in interest rates and a reduction in QE, and that is what we expect.
So, Gillian, can you have that significant increase in rates and the reduction of the balance sheet and not have a recession? Because a lot of people are concerned about that.
Well, I think there is certainly a very significant risk that we're heading towards stagflation, which is something that, frankly, most investors don't actually know how to deal with because we've not seen it since the 1970s. And there aren't that many people around who've actually traded it actively who are still on trading desks. I slightly disagree with Peter. I think the Fed has got way behind the curve. And I think that this is really the week when the markets began to wake up to that and really understand that there is going to be a series of potentially quite dramatic interest rate rises this year. We cannot guarantee that that's going to not put the economy into recession. We've had people like Jim Bullard come out and say this week that it would be a complete fantasy to think that you can actually take away this level of inflation and bring it back down just by tinkering with a few interest rate rises. I mean, the Fed really is signaling some quite serious interest rate rises coming down the track. And I think the thing that's really alarming for people right now is that although it would be convenient to blame all of these price hikes on Vladimir Putin and the energy complex, if you talk to people in business today who are dealing with supply chains, with warehouses, with trying to hire people, there is an absolutely universal message coming across that wages are going up, conditions are tight, and inflation is anything but transitory, to use that phrase that was tossed around last year. And you can't just blame that on the Russian invasion.
Well, Gillian's right, but the controversy in the data that actually Gillian just aptly ran through is that if wages are going up and labor conditions are tight and unemployment is dropping, that is not a condition for recession. The condition for recession is wages are flat and going down, you're losing jobs, people are therefore not going to spend, and that's what causes a recession. So we don't have a recession. We have growth. Now, whether we have stagflation or not, it's an interesting question. We haven't seen stagflation, frankly, since the 70s in the 80s, and that was accompanied by a significant oil shock, much, much greater than we have today. So I'm a bit dubious about stagflation. I do think we're going to see a significant rise in interest rates, but let's just examine that for a second. If the 2 to 10 year was 100 basis points in difference, which is actually not abnormal, quite normal, you would have a 10-year rate of 3.4%. which would be 60 basis points higher than what it is today, a substantial rise. That wouldn't be unusual. So I think that what's happening is we're getting a normalization of interest rates, and the market is certainly reacting to that. It hasn't seen it for a long time. But I don't think that that's the cause for a disaster here. I think it's a cause for reallocating capital and determining what stocks are going to do well in that kind of environment. Bonds are absolutely going to get crushed from a duration point of view, and spreads are going to increase. But people are still financing in the market, and acquisitions are still happening, and Elon Musk said they're going to buy Twitter. So that's just not a recession.
Well, Peter, I would actually agree with you in some ways. I don't think we're certainly not in a recession yet, but I think the risks are rising. And I think the other thing that is very striking is that we've been living in the last year or two through a period of extraordinary liquidity. The Fed's balance sheet doubled during the COVID-19 lockdowns. We've had the loosest financial conditions index in the Goldman Sachs series, since records began. And we've been drowning in liquidity. And the problem is that, in a sense, we've been drowning in liquidity for such a long time that I think many investors and asset managers have almost forgotten what it's like to have anything like tightening liquidity conditions. Now, to my mind, one of the most interesting developments of the week was actually a survey by Merrill Lynch, Bank of America Merrill Lynch, looking at fund managers, which they do on a monthly basis. And that produced the gloomiest economic outlook seen since the series began about a quarter of a century ago. And maybe you're right, that doesn't necessarily equate to recession, but it does equate to a lot of uncertainty, nervousness, and jitters that I think could certainly cause real strains in the market, particularly when we actually get Fed tightening. And we've not actually seen the Fed tightening yet. But if we actually have it coming and hitting investors, I do think there's potential for some very uneasy.
Yeah, no, I agree. Actually, Gillian, you and I agree 100% on this point, because what I think is going to happen in the market is when the Fed starts to tighten and investors see actually what the Fed is going to do, and they actually continue to see numbers, as we have been seeing, drop in unemployment, continued increase in wages, and they see actually earnings come out for the first quarter that are not a disaster, I think then the market will actually find its legs. But until then, we're seeing all this volatility. Markets decline substantially. It's resetting its valuations. All that makes total sense to me.
Yeah, but Peter, to pick up on your point about the wages are going up and unemployment's really low, as I understand it, there are a couple of things that can cause a recession. One is demand destruction. The prices get so high, people stop buying things. Number two is the Fed decides they really are behind. I mean, we had 8.5%, right, the CPI. Now, we don't think inflation's 8.5%, but it may well be well above the 2.5% neutral rate that the Fed's talking about. And if you're really trying to get it up to a positive real rate, you're going to have to go a long way.
Well, I don't think frankly, any of us know, and all the people that have been commenting about this don't actually know how much of that 8.5% headline inflation rate is really induced by supply constraints, the war in the Ukraine, coming out of COVID, and we don't know how long that's going to last for. Now, the Fed used the word transitory, which looks pretty silly, and I, by the way, was not a fan of that word either, because I didn't think transitory meant that 8.5 was coming back down to 1.5 or 2. But I do think that the long-term inflation view is still 3%, and you can still see it in the 10-year interest rate. So I guess what I'm saying, David, is that it's natural for wages to go up. It's natural for us to have inflation, even 3.5%. And that means if we had 3.5%, to get a real rate of interest, which we haven't had in 10 years, you would have to have a 10-year rate that is north of that inflation rate. North of that inflation rate. And the point that Gillian made, you can't take $9 trillion off the Fed's balance sheet and not expect it to have some effect.
Yeah.
And it's going to be financial tightening.
Yeah, Gillian, I want to pick up one thing that Peter talked about, which is supply chains. And forgive me if I start to hear supply chains a little bit like transitory. It's always supply chains that's going to get fixed, and yet if you turn around, there's a war in Ukraine. If you turn around, there's a shutdown in Shanghai. There's always something with the supply chains. Is that going to correct itself?
Well, the reality is that we're not just dealing with a cyclical issue here. We're dealing with a fundamental structural issue in supply chains, which is, yes, pressure on supply chains goes up and down with demand. But you have to understand that for the last 2 or 3 decades, the dominant paradigm in Western business has been to outsource everything that you possibly could and to run everything on a kind of just-in-time basis where you essentially only had just enough inventory of whatever you needed to keep yourself going. Anything more was seen as being inefficient. And for each company to essentially try and optimize their supply chains in terms of what made sense for them without looking at the system, the ecosystem as a whole. Now, what's happening right now is you're having a really radical rethinking of all of those elements, both in terms of the idea of endlessly outsourcing everything, that's going out of fashion. The idea of trying to do just in time is moving to just in case, basically stockpiling, inventory, having a plan B. And you're also seeing groups increasingly trying to look at the market as a whole, not just in terms of individual companies. And all of that is putting pressure on supply chains, this massive reconfiguration. And the CEOs I'm speaking to are saying that they don't expect the supply chain disruptions, if you want to use a polite word, to work their way out of the system for another 2 or 3 years. 2 or 3 years. Now, tell me that won't in some way affect what kind of wages workers are going to start asking for if they keep seeing these kind of inflation prints coming up this high. And to my mind, the other big question, which really comes out of what Peter said, is that history shows that sometimes policymakers get lucky and deflate bubbles smoothly. We may have seen something like that in the tech sector in the last few months, where essentially a bubble has been deflating. But do we really believe that the bond market bubble, on the scale that we've seen it after a decade of negative real rates, is going to deflate smoothly? If policymakers pull that off, fantastic. They deserve to be in the history books. But I feel very doubtful.
Okay, Peter Kraus and Gillian Tett are going to be staying with us as we turn from markets this week to the effect of the war in Ukraine on investors next week and beyond. That's coming up next on Wall Street Week on Bloomberg.
The truth is that the American tradition, despite our globally renowned fondness for firearms, has profound strains of pacifism and isolationism at its core. From our founding fathers' outspoken commitment to no entangling alliances, right through to the excesses of the America Firsters, this has been a nation historically suspicious of international involvements, and so reluctant to race into battle that we were conspicuously late entrants into both world wars.
That was Louis Rookheiser on Wall Street Week way back in 1996, expressing his concern over possible U.S. withdrawal from the world stage at a time that looks very different from now, when the United States is sending hundreds of millions of dollars worth of armaments to Ukraine and leading a coalition of countries to impose severe economic sanctions on Russia for its invasion. Peter Kraus of Aperture Investors and Gillian Tett of the Financial Times are still with us. So, Gillian, let me turn first to you. As I look at that and I look what's going on right now and look at what this means for investors, we do have a big war going on with a lot of tragedy and a lot of potential consequences for geopolitics. Are we seeing potentially a change in the world economic order as well?
We're absolutely seeing a change in the world economic order. That wonderful Francis Fukuyama phrase that we lived in the end of history at the beginning, or the end of the 20th century, beginning of the 21st century, has been shown to be completely wrong, because essentially history has been going backwards. And we're seeing what we thought was a world that was globalizing as a whole, essentially fragmenting into the US-China spheres of influence, the so-called bamboo curtain, to cite Hank Paulson, and the increasing split between the Western Bloc and the Slavic Russian Bloc, if you like, the new caviar curtain. So you're essentially seeing 2.5, potentially 3 different areas emerging. And that is really a very big shift that we haven't seen this kind of magnitude of upheaval for several decades.
Peter, we've had Larry Fink recently saying he thinks it's the end of globalization, which I think a lot of people thought was overblown. That's way too soon to call that. But are we seeing, as Gillian suggests, perhaps at least dividing up in part into some blocks around the world, which is quite different from where we thought we were headed?
Yeah. Look, I do think that this Russian incursion into Ukraine that has created a geopolitical shift is going to reverberate through not only political affiliations, but also economic affiliations. I think to say that globalization is dead is way overblown. I don't think that that's even in the cards. But I do think that there are going to be numerous places in which companies are going to decide to actually accept a higher cost of manufacture and thinking they can pass that through to the consumer. And so you're going to have higher structural inflation as a result of that. Now, will that structural inflation be offset by technological advances and innovations? It may well be, but I think clearly we're going to see a change. The more interesting question to me about vis-a-vis globalization is this trading bloc point that you raised. China has attempted and still attempts to actually establish a contrary trading bloc to the U.S. and its allies. The U.S. and its allies are far, far bigger. If the U.S. and its allies, through this geopolitical change, decide to actually operate in a more concerted fashion, as happened after World War II, that's going to create an enormous issue for the Chinese and other people in that other bloc, because they need to trade with this Western bloc, and they need to trade significantly with it. So it's sort of up to the Western democracies and the Asian democracies about how they play this. If it all balkanizes and people go their separate ways, that's probably not a good thing for the economics and for the markets. If there is some sense of cohesion and an attempt to create more free trade capability between that bloc, I think that's actually an increase in economic activity and good for markets.
Gillian, is it possible that what we might give up in sort of convenient dealing with one another with some countries will be made up for in other places? That is to say, is it likely this would drive a closer union with, for example, Western Europe, Japan, South Korea, even Taiwan?
Well, there is a optimistic scenario which is, tossed around, say, the chip sector or various parts of industry right now, which is that, okay, so America can no longer count on China as being the factory of the world. It can no longer count on having this labor supply side shock where suddenly wages are depressed because you can outsource everything to China. Let's bring it back into North America, maybe put more factories into Mexico. You'll create more jobs back in the US. And guess what? You'll be environmentally more green as well, because you won't be moving things around so much. That's the kind of optimistic scenario of essentially this reshuffling of the geopolitical order. The pessimistic scenario, though, is that, of course, many commodities and raw materials are not found within the allied trading bloc at the moment, and you can't suddenly create lithium mines overnight, even though Elon Musk tweeted that he'd like to this week. Another problem is that it's not clear that America has a workforce for even supporting some massive reshoring of its manufacturing industrial base. And yes, maybe you can give it all to robots, but even robots can't necessarily be the easy answer right now.
So Peter, let me ask you, this is Wall Street Week after all. Help me make some money here. If in fact there is what Gillian just called a reshuffling of the world order, where does that tell me I should put my money right now?
Well, look, you can't answer that question and say, put your money here for the next 2 weeks, 3 weeks, a month, whatever. Right. You have to look at this over a longer period of time. But Europe has clearly made the statement that they're going to invest in their energy infrastructure, which means alternative energy. They're going to invest in defense. And those two areas have enormous tentacles throughout their economies and all kinds of companies that'll benefit from that. I do think there will be some attempt in the United States to actually build some semiconductor and chip capability that people are concerned about as have been offshored. So you're going to see investments in that. You can see it in the Intel announcements and the attempt to build large plants in the South. So I don't think it takes a great deal of imagination to see where to put your money over the long term. I still think this geopolitical question that Gillian and I are sort of touching on is a big deal. And the longer term trends and the bigger opportunity to make money is trying to figure out where that is going to fall.
Peter, there was one other event that certainly shook those of us in New York and around Wall Street this week, and that was that shooting in the crowded Brooklyn subway. As someone who's spent so much time on Wall Street, do you think that may have longer-term effects, particularly as we try to bring workers back to work? It's shaken up a lot of people.
I think it's a terrible tragedy, and it's horrible for New York. But New York survived 9/11. It survived many other things, and we will survive this, and we will continue on.
Okay, thank you so very much to Gillian Tett of the Financial Times and Peter Kraus of Aperture Investors. Coming up, we take a look at what's in store next week. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Now we take a look at what's up for next week, starting with Juliet Sally in Singapore.
Hi, David. Investors in Asia will once again be searching for clues as to whether China can meet its aggressive 5.5% growth target, which is looking more and more challenging amid its COVID-zero strategy. First quarter GDP and monthly activity data this week will set the scene, and we're on watch for cuts to the loan prime rate and RRR. Meanwhile, expect all of the above to be atop the agenda at the BOA Forum, the annual gathering of political and business leaders in Hainan. Now over to Danny Berger in London. Danny?
Thanks, Juliet. Well, the contours and tactics of Russia's war in Ukraine continue to change as we enter yet another week. With the U.S. warning of a more protracted war and a more violent one, Russia looks to be concentrating their operations in the east. Meanwhile, European and U.S. nations look to supply Ukraine with more weapons. Now, let's get over to Romaine Bostick in New York.
Thanks, Danny. Earnings season picks up next week with more than 6 S&P 500 companies reporting. Notably, Bank of America and American Express, which should each provide insight on consumer borrowing. Quarterly updates from United and American Airlines will shed more light on travel trends, and there's going to be a lot of attention paid to J.B. Hunt. The shares have tumbled into correction since the trucking company's last earnings report. This as industry-wide data shows freight prices falling and capacity rising. Other earnings to watch include J&J, P&G, IBM, Tesla, Lockheed Martin, and Netflix. The week will be relatively light on economic data. The most notable releases, though, will be housing starts and existing home sales, as well as the Fed's monthly Beige Book, which compiles surveys taken of local businesses about economic conditions. David?
Thanks to Juliet Sally, Danny Berger, and Romaine Bostick. Coming up, it's tax time in the United States, and we turn to the man most identified with getting our taxes down. Grover Norquist, president of Americans for Tax Reform. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. April 15 is the time of year when most of those of us in the United States turn to taxes. Though this year, the Good Friday holiday gives us an extra weekend to get them done. But whatever the time of year and wherever you are, taxes loom large for all investors. What do tax rates mean for how much we invest? What do they mean for when we invest? And for that matter, when we cash out? And how does the structure of the tax code affect where we invest? Grover Norquist has devoted his career to addressing questions just like these. He is the founder and president of Americans for Tax Reform. That's an organization that President Ronald Reagan urged him to start back in 1985. So, Grover, thank you so much for joining us. Really appreciate it. You are the man on taxes. And let me ask you, going all the way back to 1985, when I look at the percentage of federal revenues as a percentage of GDP throughout that period of time, it has not gone up, even from the days of Ronald Reagan. Have you succeeded? Should you declare a victory?
Well, yes, in the sense that the goal is to have the government take less of people's resources and allow them to have more freedom and more liberty, and to have businesses invest based on what's a good investment, not what tax policies are. So I'm happy that we've stopped a lot. We've taken the rates down dramatically. Remember, top rate was 70% when Reagan walked in the door. It got down as low as 28%. Unfortunately, Bush let that back up. But there's more to be done at the national level. The reduction of the corporate income tax that the Republicans did in 2017 made us more competitive with China. The danger with the tax increase, one of the tax increases that Biden's looking at, taking the top rate to 28, the corporate rate, that would put it up higher than China, higher than anyone we compete with in Europe. When we were at 21, we were much more competitive. We are at 21 now. But if we go back up to 28, and you have to add, most states have a state corporate income tax, we become very uncompetitive with China, Japan, Europe.
Grover, as you know better than I, it's not just the marginal rate that counts, it's the total tax burden. And if you look at OECD countries, in fact, they have VAT taxes, other taxes they pay. And there's a Peterson Institute study that actually says we're at the bottom of the pack when it comes to OECD countries, the competitors. What do you say about those numbers?
Well, we have less taxation as a percentage of our income, as a percentage of our assets, which is good. That's why we've historically grown faster than Europe. That's why the GDP is stronger in the United States per capita than other places. The value-added tax that they have in Europe is how they got government bigger. There's a certain point at which you can't get any more blood out of the turnip with individual tax rates, both on companies and on individuals. We're probably above that point now. But the Europeans have decided you can increase the size of the government with a value-added tax, which is in some cases 21, 25% in Europe. It's a sales tax at all levels of production. And that's one of the ideas that some in America have. Why don't we have a carbon tax, which would then become the VAT tax? Then we'd look like Europe. And I guess my argument is if you want to see innovation, growth, job creation, you don't want to look like Europe.
Grover, is there a right number for the percentage GDP that should be taxed? I mean, there's something called Hauser's Law that I've read about that says basically no matter what the marginal rate is in the United States going back to 1945, we come out with somewhere between 17 and 20%. Right now, I think we're about 17.9%. Is there a right number?
I think you find that out by bringing it down and seeing if it gets you more growth. You certainly saw when Coolidge cut tax rates, you saw strong economic growth until Hoover raised them. And then when John F. Kennedy cut marginal tax rates, you had strong growth until Nixon raised taxes. And with Reagan, you had the strong growth until Bush, and then Clinton raised taxes. So we've been getting towards a point which may maximize revenue. I'm not sure maximizing revenue is the key. I'd like to maximize growth and job creation and innovation. Certainly, we learn a lot from the states. There are 50 states. 8 of them have no personal income tax at all, and they tend to be doing better than other states. People move to Texas and Tennessee and Washington State and Florida. And now there are another 8 states that have single rate taxes. So even Democrat or progressive states like Massachusetts and Illinois have lower income tax rates on individuals, 5% in Massachusetts, about 4% in Illinois, because it's a flat rate tax, and that's difficult for politicians to raise, easier to reduce. But there are now 8 states that have income taxes that are phasing those out. You just saw the vote in Georgia to begin phasing out the income tax to 0. Mississippi's done the same thing. Louisiana did last year. Iowa, top rate individuals, 6.5 down to a 4%, under 4% flat rate, with the goal of then taking it down to 0. Oklahoma is looking to do the same thing, both in North Dakota and in West Virginia. One body has voted to phase it out to 0, and the other's looking to do it. So there's a movement to follow the success of the lower income tax states nationally among the 50 states. And we've seen in the United States, when we took our corporate rate with the Reagan tax cuts down to 35, we had one of the lowest corporate rate taxes back in the 80s. Then all the other countries said, that's a great idea, and they all came in under our 35% rate. And so for quite some time, we were very uncompetitive. We're down to 21% now, which makes us fairly competitive, but not ahead of everybody else, just in the middle.
Grover, talk about that relationship between taxes on the one hand, the rate of taxation on the one hand, and economic growth on the other. Is it that clear a relationship? Because as I recall, as you mentioned, there's a Clinton tax raise during the Clinton administration, and in fact, growth went up, did it not?
Well, you also at that point had a significant cut in the capital gains tax, which the Republicans forced through in '94 as soon as they took control of the House and Senate. Growth under Clinton was weak for the first 2 years when he was threatening all sorts of tax increases. When the Republicans took the House and Senate, it meant there wouldn't be a tax increase. In fact, there was a cut in capital gains taxes. That's when you saw the dramatic growth that flowed through. So watch Congress more than the president when you want to see what people think will happen with taxes, because Republican presidents can get forced by Democratic Congresses to raise taxes. Democratic presidents can get forced by a Republican Congress to cut them. Watch the Congress to see how it goes. But on the competition issue, one of the most dangerous things that's being discussed is this global minimum tax, which would end tax competition. So instead of competing with lower taxes and low costs of government, we're going to compete with what? Lower wages. That's not what America wants to compete on. We want to compete on a more competent government with lower tax rates and more innovation that flows from that, not by trying to beggar thy neighbor with lower wages. So this OPEC or cartel of getting all the countries together and saying, we're going to trust China won't cheat, which by having lower tax rates than you're supposed to, one wonders, and so many of their companies are run by the government, it'd be awfully easy to manipulate that compared to the United States or European countries. I think the idea of a cartel where the governments get together and set a minimum tax would stop tax competition, which has been very healthy. And in the same category, the other danger that we're hearing about is price controls on pharmaceuticals. It's sort of a tax or a confiscation of people's wealth, but it also means less innovation, less investment into pharmaceuticals for the next time there's another COVID. That's particularly damaging. And there's 2,000 years of history of very bad results every time you fix prices, when the government fixes prices and has wages and or price controls.
Yeah, I should note that I think that part of the motivation for the global minimum tax was to avoid what you were describing earlier, which is putting U.S. companies at a disadvantage. But I really am curious, Grover, more generally, you've been on this quest for a long time now. You've been very consistent about it. Is what drives you fundamentally economics, that is the need for more growth, or is almost a matter of philosophy or even morality about really what's fair and what's right about how much the government gets, how much individuals get?
I think it's three things. The Constitution's fairly clear about certain limits, particularly on the federal government, on taxation, what's allowed to be taxed. The idea that Biden has of taxing assets or unrealized gain is clearly not constitutional. The courts have ruled on this in the past, but you just have to read the Constitution to see the very limited number of powers that the states were willing to give the central government when they agreed to the Constitution. They made it very clear what you can and can't do. Taxing assets, taxing wealth, taxing unrealized income, meaning income you don't have. The value of your house goes up and they want to tax the income you got because your house is worth $10,000 more. That sort of thing, bad policy, but it's also not constitutional. So I think step one, is it constitutional? Step two, is it good for the economy? Why would you raise taxes at a point where it kills jobs and slows economic growth? And then third, there's a preference. If you earned $1, it's yours. And the government needs to have a very good reason to explain why it has to take your dollar and spend it some other way. So I think that we ought to say, you earned it, it's yours. Now the government has to make the case why it's actually necessary and important and not counterproductive to take some or all of that.
It's awfully hard to have a meaningful discussion on taxes without talking to Grover Norquist. Grover, thank you so much for your time today. That's Grover Norquist.
David, thank you.
He is president and founder of Americans for Tax Reform. Coming up, we wrap up the shortened holiday week with Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we are joined once again this week by our very special contributor, Larry Summers of Harvard. So, Larry, we got those CPI numbers out. They came in just about as bad as everybody expected they would. Let me ask you, do you think we're peaking in the inflation now? Because some people think this is about the peak.
I think we're probably peaking for the next several months. There was a huge component from gasoline this month that I don't think will be repeated in the next several because of the base year effects. I think the number is going to come down. Whether we're peaking indefinitely, I'm not certain that that's going to happen. It'll depend on luck, and it'll also depend on the decisions that the Federal Reserve makes.
And one of the questions is how sticky it's going to be. There's this trimmed mean way of calculating inflation, which is now up at 6%. It's the longest in history since 1984. What do you make of that?
Look, there's been an effort, as there always is when you have inflation, to dismiss it as due to specific or temporary factors. That is much more wrong than right. You can see it when you take out all the extreme observations in both directions, as that calculation does. You can see it, as I've emphasized, by looking at the wages, which are the ultimate source of costs in the economy. We've got a pretty fundamental inflation problem in our country. You know, David, I saw something recently that brought this home to me. People think of us as having had 13, 14% inflation in the 1970s, but that's only because of the way it was calculated then. If you use the same way we calculate inflation now, it got just above 10% in the 1970s. So getting to 8.5, we're actually closer to being back there than I think most people realize.
So given that, and that's a really interesting fact, I must say, I did not know that. Given that, what should the Fed's realistic goal be right now? I mean, they cannot get it back to 2% by next month, goodness knows.
No, look, I think we need to go back to the old idea of price stability as being when people aren't thinking about inflation as part of regular economic calculations. And we need to move away from the detailed fixation with numerical targets, which it seems to me has led us to unhealthy places. So I'd go back to a general definition of price stability, but we are nowhere close to that right now. And I would worry about the clamor of voices that are saying that, 4% inflation could be okay, or even that inflation above 3 could be okay. I think we need to be very determined to come way down from where we are right now.
Larry, there was a Bank of America survey of fund managers out this week, and the big headline was concerns about stagflation. It's higher than it's been since certainly 2008 or so. How concerned should we be about stagflation?
I think it's the most likely place we're going to be. If stagflation means rising unemployment and still high inflation, I think that's the preponderant probability as to where we're going to get over the last couple of years, over the next couple of years. As I've said before on your show, David, the painful fact that needs to inform our view is that we've never had a moment when unemployment was below 4, inflation was above 4, and we avoided recession for the subsequent 2 years. And right now, unemployment's well below 4, and inflation is well above 4. Lots of people say, look, the job market is so strong, why would anyone think we're going to have a recession? What the data show is that the lower unemployment is, the more likely it is that it's going to turn down in subsequent months.
So that was last week. Next week, of course, we have those meetings in Washington, the IMF and the World Bank. In anticipation of that, it appears, the Secretary of Treasury, Janet Yellen, had a speech before the Atlantic Council this week in which she really said, we've got to decide which side we're on, apparently pointing her finger sort of at China, saying you need to decide where you're going to come out because of the conflict with Russia over Ukraine. What about the use of international economic and monetary forums to really address things like national security?
Look, there's plenty we need to work out with respect to China. But let's start with the fact that the United States has now committed no funds to international COVID relief efforts. Let's start with the fact that the United States is a massive laggard with respect to climate change commitments because we haven't been able to pass anything through Congress. Let's start with the fact that Russia is earning more export revenue than it was before the war, and the ruble is stronger than it was because our European allies are continuing to import oil on a substantial scale. I think we need to start in those places before we go after China. I think Secretary Yellen has been enormously successful in her leadership on global tax issues, including bringing China into that regime. But the U.S. Congress isn't there, and I think that's a hugely important thing. I think that we do need to address the Chinese in a strong way, but we need to make a decision as to whether the U.S. strategy is to use international financial institutions as a strategy and a route to cooperating with China in those spheres where cooperation remains possible, or we need to conceptualize those institutions entirely as means of containing, disciplining, and limiting China. We haven't really given entirely clear signals on that. I think we should still be trying to take the former approach of using them as tools for engaging China. Finally, I hope that we're going to see in the next months a U.S. strategy that's clear and explicit towards the World Bank. It seems to me that as climate change has loomed larger and larger as a problem, as there has been a major pandemic issue, as the need for relief around the world has stepped up, the bank has really not stepped up as a major player. And given that the U.S. is the largest shareholder and appoints the president, the U.S. has a responsibility at this point to energize the bank.
Okay, let's have a two-issue, really rapid round here, if we could. Number one, Elon Musk. Now, he said he wants to do a hostile takeover. He announced it this week, toward the end of the week, of Twitter. What do you make of that?
Twitter may be practicing what it preaches in terms of being a source of news, volatility, and drama. This is going to be quite a story.
Quite a story indeed. And finally, one issue in the news this week was you, and to some extent even us, because there was this piece by John Cassidy in The New Yorker, which really takes you on with your inflation predictions, some of which were made on this program. In fact, it quotes Wall Street Week specifically. And one of the things it takes you to task on is, on this program back in March of 2021, you said there's a one-third chance. One-third of runaway inflation, one-third wouldn't happen because the Fed really had to clamp down hard, and one-third will muddle through. They think you were too vague. I'm not sure we thought you were vague at the time, but what's your response?
I don't know. For someone who is vague, I sure made a lot of people in the administration mad with the force of my view. It's kind of remarkable that they're saying that in that piece, that I had the numbers wrong, given that they're the people who are forecasting 2% inflation, and they're the people who have the budget that said this year that the Treasury yield's not going to rise above 1%.
In the meantime, the administration anonymously is quoted actually as taking you to task, saying you had overestimated the output.
Look, I think all we need to do is look at the numbers on inflation, and I sure hope that their more optimistic forecasts will turn out to be right. And look, we all have a huge stake in their success.
Don't we all? Thank you so much, Larry Summers, our very special contributor on Wall Street Week. Coming up, everyone says they want tax reform, but are we sure? This is Wall Street Week on Bloomberg. Finally, one more thought. Death and taxes. Benjamin Franklin famously wrote that they were the only things that were truly certain, though it turns out he took that truism from an earlier writer back in 1716. But when it comes to taxes, it's more than just the need to pay them that's certain. There's also the certainty of the debate about them, usually between the need to cut them and the need to make sure everyone is paying their, quote, fair share.
For too long, we've lived with a tax system that is a blot, a stain on the shining mantle of our democratic government.
Wall Street didn't build this country. The middle class built the country. I think you should be able to become a billionaire and a millionaire, but pay your fair share.
And just as certain is the pledge to reform how we pay our taxes, not just get the overall level right, leading us to a recurrent debate, for example, over deductions for state and local taxes, that so-called SALT deduction that President Trump severely cut back and that Democrats, particularly from the Northeast, keep saying they will restore.
This all speaks to the challenge that Democrats have before them. You did hear a restatement from a number of Democrats saying that they would not support legislation that does not have the SALT tax in it.
And of course, there's the recurrent claim over the capital gains treatment for so-called carried interest for private equity income. Maybe the one thing that President Trump and President Biden could actually agree on.
The president very specifically campaigned against carried interest for hedge funds and for that industry. That's really what he's focused on.
Keeping this tax loophole, which leads to folks who are doing very well paying lower rates than their secretaries, is not in any demonstrable way improving our economy.
And now we have a new candidate for so-called tax reform. It's a billionaire's tax that would make the very wealthy pay for appreciation in their assets every year, whether or not they actually get the cash.
Right now, billionaires pay an average rate of 8% on their total income. My budget contains a billionaire minimum tax because of that. A 20% minimum tax that applies only to the top 1/100th of 1%. 1/100th of 1% of the Americans will pay this tax.
And so this year, as we pay those inevitable taxes, we can rest easy that people will keep talking about some kind of reform that never comes. But then again, the late, great Art Buchwald warned that tax reform is taking the taxes off things that have been taxed in the past and putting taxes on things that haven't been taxed before. So maybe we shouldn't be in too big a rush for tax reform after all. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.